Hi everyone, good evening. Well, I've been a little busy with some personal tasks and hence the break. Now, in the past 1.5 month, however, the stock markets have been jumping up and down like crazy. One day, everyone is celebrating, the markets are up, and the very next day, panic sets in, and everybody is saying, "Oh, what's going to happen? What's going to happen?" That's understandable from a investor who's been in market only for the past 4 5 years. If you are one of those, then you've seen nothing but a bull market. But if you've been in the market for, let's say, 10 or more years, then you've seen a couple of times when markets scaled back and prices dropped, then the so-called market corrections happened. But if you're a small investor looking to invest for the long term, how do you stay sane in this madness? Today, I'll share 7 simple practical strategies to navigate this market volatility. No complex jargon, no unnecessary drama, just clear, actionable insights. So, if you're someone who wants to invest wisely without losing much sleep, watch till the very end. The first and the foremost, stick to your SIPs. SIPs which you're running are like your gym membership. Stick to your gym day in, day out, and sooner or later, you'll see the difference in your physical health in your body. So you put in a fixed amount every month, and over time, you will see the results. Instead of trying to time the markets, SIP help you average out the highs and lows. It's the simplest way to build wealth steadily without getting caught in the market swings. The most important part, if the markets fall, your SIPs buy you more units. If the markets rise, your existing investment grows. Either way, in the long run, you will win because India's economic trajectory is up. Step 2, avoid overthinking. And for God's sake, Bhagwan ke liye, stop checking the prices daily. Checking the prices daily is like checking your weight every single day after every single gym session. It doesn't work. You check your weight once in 15 days, maybe once a month. That's more than enough. Similarly, if you've invested in decent, good quality stocks and you've done your research right, then you don't need to check the stock prices every day. In the short run, the market prices will go up and down. But in the long run, the business you have invested in, if it is growing, the prices are certain to grow. If you really want to track something, instead of prices, track the company's performance over a period of time, starting from the time when you invested and every quarter from there on. Do not, for God's sake, check the stock prices every single day. The third point is diversification. You need to diversify your investment portfolio. And when I say diversification, I don't only mean diversify within the stock markets. Stock market is an avenue for investment which should form a healthy part of your portfolio, but it should not be all of your portfolio. You have to look at other asset classes like gold and real estate to a certain extent. Though both gold and real estate will not provide the kind of growth spurt a stock market investment will do, but both of them are stable assets and will help you balance out the volatility. The fourth point, invest in quality companies. Now, what do I mean by a quality company? A company whose sales is growing, a company whose profits are growing, a company with a strong business model, a company with a very clearly defined growth plan. These are all signs of a company and the underlying business being on a strong footing. Now, once the footing is strong, then the question which remains to be answered is at what value are you willing to enter this company? And that's up to you to decide. But if you don't do the process of vetting the company's financials and then identifying a stock price or a valuation level which you are comfortable with, then you are in chasing hot stocks or tips from WhatsApp University. It really does not help. Then you're literally gambling. If you're one of the latter, it's better you go to Goa and go to the casinos there. You'll get the same thrill. And trust me, you will lose much less sleep over it. The fifth point, keep your emotions in check. For the past 5 odd years, when the prices have been only on a one-way trajectory, which is up. The only emotion you felt was exhilaration and more exhilaration. Today, when at the first sign of correction, wherein the indexes are down anywhere between 10 to 15%, a lot of investors are selling off their portfolios and telling us that they will enter again later when the fall is complete. To be very honest, on paper it looks like a good strategy, but there are 3 4 issues with it. The first issue is, can you really time predict when the fall will be over? The answer is no. The second issue is, will you have the guts to re-enter the market at that level at that point of time? The answer is maybe. And the third point is, will you have that corpus remaining at that point of time to invest? Now, if you were somebody like me, then I have a problem maintaining a corpus of my own. If it is not invested, it gets spent. The golden rule is, don't give in to fear, keep your emotions in check, avoid panic selling, and stay rational. The sixth point, focus on the long game. What do I mean by the long game? When you buy a house with a thought that I will be staying in that house for at least 5 to 10 years. So that's a rational and long term decision. But when you buy a company, why do you have to think of selling it in a quarter, in 15 days, and exiting with profits? It's better to assess a company for the long run and to identify and invest in a company in which you can stay invested for decades. Compounding works not only in stock market, it also works for businesses. Great examples: Titan, Reliance, Wipro, all are compounding machines. People who invested in the companies in 2000s are all reaping the compounding benefits. Stay invested in the company. Don't bother about the minor ups and downs. Every company which is valuable today has seen 50% drop in prices at least 3 or 4 times during its 7 to 10 year or 20-year rise. Simply by holding on, you are generating wealth. But this is when the company's business is stable and you are confident in the business model as such. So the wealth formula is, stay invested, keep adding funds regularly, and let the compounding do its magic. Don't really bother about the small potholes which come along the way. Seventh, last but not the least, get professional help. Get an advisor, pay him his fees, and take his advice. If you're not really someone who can, buy and forget, or buy and, not to be emotional about the purchases or the short term ups and downs, then it's best you get an advisor. Advisor can be a PMS, fund manager. Advisor can be a simple investment advisor, SEBI registered investment advisor. And you can take his advice in terms of what to buy, what to sell, when to buy, when to sell. Of course, he's an advisor. The final decision is yours, but at least you will have one betting point and someone who can tell you if you're selling it emotionally or if your logic of selling it is correct. Well, if you can't get an advisor, it's simple. Invest in mutual funds, invest in index funds, and be done with it. Don't bother timing the market. Don't bother picking up individual stocks. Let's do a quick recap of what we discussed. The 7 steps. First, invest through SIPs and keep investing through SIPs. Stop checking share prices and stock prices on a daily basis. Diversify wisely across asset classes. Pick quality companies. Control your emotions. Focus on long term growth. And finally, get professional help if needed. With this, I will end this video. If you found this helpful, hit like and subscribe. And do let me know in comments what is your biggest challenge in investing. As a bonus, check out this video where until next time, stay calm, stay invested, and keep building wealth. Until next, thank you.